No, the banking crisis isn't over. But on the other hand, at least there's a way to handle troubled banks, a way to get out of this jam. Oh, and to be sure, I'm downgrading this one from crisis to jam. Because if you're jammed, you can get unjammed. There's a way out. That's what happened today when we learned that some medium-sized outfit named First Citizens Bank shares had to look up the darn symbol, took over the failed Silicon Valley Bank's branches, loans, and deposits. It is a sweetheart deal because they're buying $72 billion in loans at a $16.5 billion discount. Now, the $90 billion SBV securities will remain in receivership. I think a lot of those Silicon Valley Bank loans, by the way, are going to turn out to be good ones. No wonder First Citizens Bank shares stocks soared nearly 54% today. That cast a rosy glow on the whole session, allowing the Dow to gain 195 points. S&P advanced 0.16%. NASDAQ dipped 0.47%. I'll go into that relationship in a second. So is this the solution for our bank-run problem? I wish. The reason this deal works is that the government already owns Silicon Valley Bank after taking the stock to zero. This kind of thing only can happen in receivership after a bank has already failed, because that can eliminate a lot of risk for the buyer. Our system simply isn't ready for a wave of bank failures. That's not an ideal solution, which brings us back to First Republic Bank, the one that looks the most like Silicon Valley, with a stock that's traded as high as $16 and change today, but falling back to $13.82 and an anemic close, although it's still a 12% rally from Friday. The opening rally, though, today, in retrospect, was premature. No bank is likely to step up and buy First Republic whole and not in receivership, because it'll immediately hurt the quarter. That's the only way they can do it, in receivership. And that's not going to happen. There's no guarantee. Well, I guess it could if things really go bad, but there's no guarantee, no indemnities, no deep-pocketed partner that makes you whole if things go wrong. First Republic has to go down before a good deal can be worked out, unless the FDIC can somehow indemnify the buyer from losses. And I have to tell you, I've worked hard on this. I can't come up with a way it can be done. That's the bad news. But the good news is the government now has a plan. If there's another old-fashioned bank run, you just close it. You zero out the bonds, zero out the common stock, and you find another First Citizens to buy what's left, because we saw that stock jumped more than 53% when it got this deal. What does this mean for the stock market? Well, it's frankly not easy to reconcile. We know there was a big slowdown in deposit flight last week across the country, with less money moving out of the regionals into the larger, safer banks. That's positive. But we also know that if the outflows start up with any velocity, say at First Republic, maybe the process will start all over again. Which brings me to what really matters. Last week, the Fed decided to raise interest rates by 25 basis points and not 50 basis points, as many thought could happen a week before that, because it was concerned about these banking crises. Now it's gutting confidence at the worst possible time for our country. While the Fed wants inflation to come down, it doesn't want it to come down in the worst possible way, which would be as a result of more bank failures. The good news is that we now know there'll be other banks like First Citizens Bank shares that are trying to figure out how much they can make if they get involved in one of these situations. You can have your stock double, sell stock, have more money come in. It's a virtuous circle. The bad news is this kind of bank collapse has a similar impact to another rate hike from the Fed, and not just a quarter-point one. Of course, First Republic isn't like Silicon Valley Bank, which fell apart in 48 hours, because it had a very concentrated deposit base, namely some large venture capital firms and their portfolio companies that bolted almost simultaneously. First Republic's deposit base could be a little more intrepid. Some people would say sticky. But if you're making these decisions at a business, you don't want to be a hero, right? You're like, oh, I'm going to just put my money in there and just hope everything does well. Just to keep the money in the struggling regional bank where you aren't protected above $250,000 worth of FDIC's insurance. And many of First Republic's, by the way, their customers are very rich and they have a lot more money than they may have coverage. Of course, First Republic isn't a sitting duck. It can borrow money from the Fed at decent rates. It can figure out how many of its depositors are protected by the $250,000 limit, then borrow to fill the gap if the government will let it. I think they will. I know I don't sound all that worried. And honestly, while I am chagrined, I am more positive than last week, because here's what's happened. I care about velocity, and the velocity of the run on the banking system has slowed. It's gone from pell-mell just last Wednesday, when Janet Yellen told Congress there was no master plan to save the banks, to less worrisome, at least for the moment. The regulators are finally getting out of the situation. That matters. I think they're going to have a plan. It's actually going to inspire confidence. I think they can make us feel like there's no need to flee from our regional banks, because depositors will get bailed out. Don't worry.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.